You've probably used something today that Norway quietly owns a piece of. Your phone's chip designer, a streaming platform, a shopping site, maybe the building your favorite brand rents. A small nation of just over 5 million people has built a financial shield so large, it quietly touches everyday life around the world. They call it the Government Pension Fund Global. Most people just call it the oil fund. I call it Norway's secret weapon. This is the story of how a country found oil and chose patience over parties. Instead of spending the windfall while the money was hot, Norway made a rule. Save first, invest globally, and let future generations benefit. That decision turned a boom into a lasting engine. Today, the fund is worth nearly 20 trillion Norwegian kroner, roughly in the neighborhood of $2 trillion US, and it's the biggest sovereign wealth fund on Earth. That scale isn't just impressive, it's stabilizing. Let's rewind. In the late 20th century, Norway discovered oil and gas in the North Sea. Many countries have found resources like this, and many have fallen into the resource curse, where easy money warps politics, prices, and productivity. Norway wanted a different ending. So in 1990, Parliament created a legal framework for a national savings fund. The first real inflows came a few years later, and by 2006 the fund had its current name. The core idea never changed: convert finite oil into a diversified, infinite portfolio. But here's the clever part. Norway decided the fund would invest abroad. Not at home. Why? To avoid overheating its own economy. When petromoney floods into a small country, prices can surge, industries can hollow out, and the currency can spike. By sending the money out into thousands of companies and bonds around the world, Norway dampened those pressures at home. It's like opening a pressure valve. Release outward. Keep your own house calm. The second masterstroke is the fiscal rule. Norway set a simple discipline. Spend only the fund's expected long-term real return, not the principal. Originally, that was estimated at 4%. In 2017, with markets and interest rates changing, they lowered the guideline to 3%. It's a guardrail that smooths the budget. When times are rough, the government can lean a little more on the fund. When times are hot, it reins in spending. Cycles become less scary when you have a reliable, rules-based backstop. Who actually runs this machine? The mandate comes from the Ministry of Finance, but day-to-day management sits with Norges Bank Investment Management, part of Norway's central bank. Their job is surprisingly humble for a giant. Be broadly diversified, keep costs low, and avoid getting cute. Most of the fund is invested like an index across global stock and bond markets, with smaller slices in real estate and more recently a measured allocation to unlisted renewable infrastructure. The result is a global portfolio that mirrors world growth rather than trying to guess it. What does that look like in practice? The bulk of the fund is in equities, shares of companies across the Americas, Europe, Asia, and emerging markets. A large portion is in fixed income, government and corporate bonds that pay interest and steady the ride. A smaller portion is in prime office buildings and logistics hubs in major cities, adding rental income and inflation protection. And a small, carefully controlled slice is in renewable energy infrastructure. Together, these pieces act like a diversified engine. Stocks for growth, bonds for ballast, real assets for resilience. Crucially, the fund rebalances. After a big market drop, when stocks are cheaper, the fund buys more stocks to get back to its target mix. After a surge, it trims. This mechanical discipline turns volatility into opportunity. It's the opposite of panic. When others sell in fear, Norway quietly restores balance. That habit requires political courage, because rebalancing often feels wrong in the moment. But over decades, it has added billions in value. Transparency is another superpower. Every year, the fund publishes what it owns, how it voted at shareholder meetings, and what it's doing to steward companies responsibly. You can see the holdings, the returns, the fees, even the letters it sends to boards. This openness builds trust at home and credibility abroad. It draws a clear line between politics and portfolio. Parliament sets the goals and ethics, professionals execute within those guardrails. When sunlight is your default, secrets don't fester. Ethics are part of the blueprint, not a marketing slogan. Norway has formal guidelines for what the fund should avoid or scrutinize, things like severe environmental damage, gross corruption, certain weapons, tobacco, and serious human rights abuses. An independent council on ethics investigates and makes recommendations. The central bank's board makes final decisions on exclusions or observation. The logic is simple. Long-term owners shouldn't profit from the worst kinds of harm, and they shouldn't ignore risks that can come back to bite the portfolio or the country's reputation. With size comes quiet influence. The fund owns around 1 to 1.5% of all listed stocks in the world. That doesn't sound like much until you realize it shows up in boardrooms. The fund votes on executive pay, on climate disclosure, on board accountability, and on shareholder rights. It publishes expectations documents on topics like child labor, water management, tax transparency, and human capital. It's not trying to be the loudest voice in the room, it's trying to be the most consistent. How has the fund held up in storms? It has lived through plenty: the dot-com bust, the global financial crisis, the Eurozone scare, the pandemic shock, inflation's return, and rate hike whiplash. In every case, the value of the fund fell sharply for a while, and then recovered as markets healed. Because Norway spends only a small slice each year, it can ride out drawdowns without liquidating at the worst time. And because it rebalances, it often buys what's hurting, so that recoveries feel like tailwinds. Of course, scale introduces new debates. One is concentration risk. So much of global equity market value now sits in a handful of megacap tech companies. That makes the portfolio more sensitive to their fates. Another is geopolitics. Owning a broad slice of the world also means getting pulled into the world's arguments. When the fund follows its ethics rules and excludes a company, some governments frown. When it pushes for better governance, some executives bristle. Staying principled and predictable is the only workable strategy. There's also the green paradox. Norway's fund is built from oil and gas revenues, but it increasingly asks companies to manage climate risks and disclose emissions. Is that hypocritical, or is it responsible long-term ownership? Norway's answer is pragmatic. While fossil fuels still meet global energy demand, the country will tax, invest, and spend responsibly, and it will push the portfolio toward transparent, well-governed, and gradually lower-carbon business models. It's not about instant purity. It's about credible, compounding progress with eyes wide open. Another question: why not invest more at home? Build more roads, more tech hubs, more everything? Norway's response is again about balance. Domestic projects are funded through the budget, and the fiscal rule keeps that spending steady. But piling the fund itself into local assets would put too many eggs in the same small basket. The fund's job is to spread risk globally and bring a share of world income back to Norwegians. It's the difference between running the country and owning the world's portfolio. What about future returns? With interest rates moving and global growth evolving, Norway doesn't assume yesterday's wind will blow forever. That's why it lowered the expected real return used in the spending rule to 3%. That cautious anchor helps keep promises realistic for an aging population. It's also why costs are kept low, leverage is avoided, and the fund's active risk, its deviation from the benchmark, is intentionally modest. The power is in scale, patience, and compounding, not clever bets. So what makes this fund a secret weapon? 3 things. First, it turns a finite resource into a permanent financial engine. Oil wells deplete, dividends and coupons don't. Second, it immunizes the national budget from oil's mood swings. Prices crash, the country stays calm. Third, it gives Norway a seat at the global economic table without waving flags. Ownership is quieter than diplomacy, but sometimes more persuasive. When you're a steady shareholder everywhere, people listen. There are lessons here for any country that hits a windfall, whether it's commodities, tourism, technology, or something else. Write the rules when you're calm, not when you're euphoric. Separate strategy from execution. Spend the returns, not the principal. Invest broadly, report openly, rebalance mechanically. And accept that ethics aren't free. They are an investment in long-term resilience, legal certainty, and public trust. Imagine if every resource-rich nation had done this. Fewer boom-bust cycles, stronger currencies, better schools and hospitals funded year after year instead of one-off splurges. It's not flashy to say we saved and invested, but it is powerful. Norway made that choice decades ago. The results are visible in pensions that feel safer, budgets that feel steadier, and a sovereign balance sheet that can face storms without flinching. Zoom back to the personal level. When you shop, stream, travel, or tap a card, there's a chance Norway's fund is quietly there in the background, collecting a small share of global profits and sending them home to a population the size of a medium city. It's one of the most elegant answers to a tough question. How do you turn luck into legacy? The formula is simple but rare: discipline, transparency, and patience. And the story isn't over. The world is changing. Artificial intelligence is reshaping industries, climate risk is reshaping real assets, and geopolitics is reshaping supply chains. A fund that owns a slice of almost everything has to keep adapting without losing its soul. That means clearer voting policies, better data, sober risk controls, and continued humility about what markets can and can't do. It also means staying grounded in the mission, safeguard value for future generations, not win headlines today. If you take only one idea from Norway's experience, take this: institutions matter more than moments. Oil was a moment. The institution of the fund, its rules, its guardrails, its culture, turned that moment into a century-long advantage. Most countries can't copy Norway's geography, but they can copy Norway's governance. The blueprint is public. The math is public. The only hard part is the politics of patience. So the next time you hear a politician promise that a windfall will fix everything, ask the Norwegian question: where are the rules? Where is the firewall? And where is the plan that still works when the boom fades? That quiet checklist is the difference between a bonfire and a lighthouse. Norway chose the lighthouse. Year after year, wave after wave, it keeps throwing light on the water and money into the future. If you enjoyed this deep dive into Norway's secret weapon, the world's biggest wealth fund, tell me what surprised you most. Should your country copy parts of this model? Drop your thoughts in the comments. And if you want more clear, story-driven explorations like this, hit subscribe and share this with a friend who loves smart economics. Thanks for watching.